Hello and welcome to this presentation on corporate structure selection for Enterprise Ireland. My name is Ben Aspinall. I'm a partner at Ecovis Wingrave Yeats UK. We are the member firm of Ecovis International, a network of around 10,000 people across 90 countries, working across business advisory with chartered accountants, tax advisors, corporate finance specialists, so mergers and acquisitions, and auditors. Within the UK, Ecovis Ecovis Wingrave Yeats covers all aspects of the finance function that you might look to outsource, so bookkeeping, accounting, VAT compliance, payroll, tax compliance, so corporate tax and personal tax advisory work, and audit. We also have a legal specialists and an M&A firm as well. And we have been working with Enterprise Ireland for 7 or 8 years, perhaps a little longer, on advising their clients as they look to explore entry into the UK. So we have put together a series of videos looking at the key considerations, the key topics that you might need to look at in terms of doing your due diligence before you enter the UK market. And a lot of the questions we get are around corporate structure selection. What type of entity is best for your business, and what are the pros and cons of those entities? So that's what we're going to cover today. At the end of it, there's some contact details for us, but also if you get in touch with your Enterprise Ireland relationship manager or account manager, they'd be happy to put you in touch with us if you fancy a free excuse me, I'm losing my voice a little bit, a free no obligations chat, just half an hour on a call to answer any questions you might have about entering the UK market or anything specific on tax or perhaps global mobility if you're looking to move people from Ireland into the UK. So we're going to cover the types of entities, the key considerations, what it takes to set up each of those entities, the ongoing compliance differences, tax considerations, and then a little bit about registered offices, because we get quite a few questions through Enterprise Ireland on what's the difference between this type of registered office and this type of registered office, and can we use this one? And it can be a bit confusing in the UK because you've got HMRC, the tax authorities, and Companies House, the registrar of companies in the UK, who have slightly different requirements. And there's also a requirement for the directors of a UK business to give an address, not necessarily their address, but an address to Companies House to have on public record. So we'll cover that and what the options are, because it's a fairly frequent question that crops up. So we're not going to look at public companies today, although if you think a PLC is something that might be a good fit for you, then do get in touch and we'd be happy to advise. I won't talk too much on LLPs, partnerships, just because it's probably only 10% or fewer of Enterprise Ireland clients that it relates to. And you're probably fairly familiar with the structure of it already if that applies to you. So 90% or more of the clients that we advise via Enterprise Ireland are limited company and branch, are looking at limited company or a UK branch of the Irish entity when they look to enter the UK market. So what that means is a limited company would be a subsidiary of the Irish entity, or perhaps a commonly owned entity, so the same ownership structure perhaps. Or a branch would be an extension of the Irish entity in the UK, so not a separate business, but just an arm of the Irish business. And there are some slight differences in terms of legal protection, maybe commerciality, and a few other things which we'll cover here. So I mentioned legal protection, so looking at liability with a branch, any claims against the business are against the parent company, so they're against the Irish business if you have a UK branch. Whereas with a limited company, you isolate that claim to the limited company in the UK. In terms of raising capital, this might be more of a perception thing, but if you're looking at private equity or venture capital investment, there may be more of an appetite to invest in a limited company than a branch. That's not necessarily always true, but it's just worth bearing in mind that a limited company signals slightly stronger market intent than a branch. It implies that you are here for the long haul, looking to really commit to the UK market. And so potentially is a bit more attractive to venture capital, private equity businesses looking to invest. But otherwise, the access to capital in terms of how you go about raising capital is the same for a limited or for a branch. Obviously, a limited company will need share capital of its own, but you can set up a limited company from as little as £1 of share capital. So there is no real barrier to setting that up. There are some tax considerations, obviously, when looking at LLPs, limiteds, and branches. The limited and the branch are fairly similar. The branch is essentially isolated to the UK activity when you're talking about corporation tax. The LLP is a different beast entirely, whereby profits are attributed to the members of the LLP, and then they pay that as personal, pay any tax on those profits as personal tax, personal income tax. And the limited, as you'd expect, is just profits on, tax on profits of the limited company in the UK. So not I'd suggest don't let the sort of administrative burden or the compliance requirements drive your decision as to which entity to go with. But certainly it is worth considering how easy it is to set up a limited company or a branch, or indeed wind them up as well if you look to exit the UK, and what the ongoing compliance requirements are for the different entities, because although it shouldn't be the main driver, it is certainly a consideration if you're only looking to test the waters in the UK. Recruitment and management is worth considering too. With an LLP, it's much easier to bring in top talent and exit top talent through adding partners and exiting partners. Whereas with a limited company, if you're going to give anyone any equity, you need to go through a valuation exercise. It's a little more onerous. And then removing them from that, it can be challenging too. So it's just worth considering how you're going to go about rewarding any sort of top level management, or sort of remunerating them or giving them any equity if that is a consideration. Recruitment wise, shouldn't be a huge difference between an LLP or a limited or a branch, except to say that perhaps without sort of what I would call like a true UK entity, so not a branch, some employees or prospective employees may feel a little more exposed, a little more at risk being employed by an overseas entity. So in this instance, by an Irish entity. Not always the case. Some people don't consider it a problem at all, but others would rather be employed by a limited company subsidiary where they know that the risks and the recourse for early action is all based in the UK or centred in the UK. And then commercially, I mentioned just commercially around sort of fundraising in the UK, but also it is worth doing your due diligence on your target market and whether or not they have been advised rather than mandated. There's no official mandate to buy British, but maybe they've been advised that they want to buy British or they should be buying British. That could be an internally generated thing just for their own perception management, or it could be that it's been within the wider industry sort of encouraged perhaps to look at buying British, so buying from UK limited companies and LLPs rather than from overseas branches. It also may for them be a concern to buy from a newly formed branch, because it may be that they're not certain of how strong your market intent is, how long you're looking to be here. So they may prefer a limited company. That is not always the case. In fact, probably in the majority of cases, we don't see that being an issue, but there's a large minority of industries where perhaps a limited company um, does become a consideration for the customer base. So it is worth considering that before you look to make your selection on the corporate structure. So looking at setup, and I'll just cover some wind up as well if you do look to exit the market. In a nutshell, the limited company takes a little longer to exit the UK market than the branch, which can be wound up pretty quickly. With the limited company, it's probably a few months to wind it up, because you need to allow a 3-month grace period for anyone to come forward with any claims against the limited company for any unsettled debts before the entity can be struck off the register. That is just really a waiting period. The actual administrative process is the same, so you go through the same process with the limited and the branch, and then the branch would be wound up, but the limited company would stay open for 3 more months before it was wound up. So not a huge difference, but it is a consideration. Onto sort of the setup process. So if you look here on screen, you've got quite a difference between the limited company and the branch in terms of the setup time. The limited company really only excuse me, losing my voice, really only takes a couple of hours, maybe a few hours, once all the information is collated, but it would allow a couple of days to get the information together, allow for any queries from Companies House if there are any, but typically there won't be. And then it's a very quick process. And as I said, £1 share capital is sufficient. So you can have a limited company incorporated very, very quickly in the UK. The branch takes a bit longer, can take up to a couple of months, can even take longer if there are questions from Companies House. That's probably to be expected, given that this is an extension of an overseas business. So there's a bit more due diligence to do, a bit more fact checking to be done by Companies House before incorporating the branch. And the LLP, it's very quick, like the limited, but obviously there is a process by which you need to have a partnership agreement drafted and agreed by partners, and that can take a little longer. So that's just worth factoring that in. With setup as well, consider banking. There is a separate video coming up on banking, so I won't go too much into it here, but it is probably the most time-consuming element aspect of entering the UK and setting up in the UK. So allow plenty of time to set up a bank account, and if you already have relationships with UK banks, then hold on to them, because they'll be very useful for you when you look to enter the UK. We've already discussed legal protection, but just to reiterate that any claims against the branch are actually made against the parent company, whereas with the limited and LLP options, they're made against just the UK standalone entities. In terms of ongoing compliance, there's only a couple of subtle differences. So the payroll and VAT compliance is the same for all entities. Accounts filing for the limited and LLP is the same. So you file your accounts 9 months after year end, typically. And the corporation tax filing for the limited company and the branch would be any payments of corporation tax 9 months after year end, but the return doesn't need to be submitted for 12 months after year end. The branch would only be a corporate tax return based on the UK activity, so the branch activity. However, with the statutory accounts filing, the parent company needs to file its accounts on UK public record for the branch. So the Irish entity's accounts would be on public record in the UK. So not usually something that worries any Enterprise Ireland client, but for some other jurisdictions it might be a consideration. So just worth bearing that in mind. The rest of it, in terms of the timings of statutory accounts, is the same. You will prepare branch accounts, but you won't actually have to submit anything for the standalone branch onto public record. You only prepare them for the purposes of preparing your corporation tax return. So not loads of differences with regards to the branch and the limited, just subtle difference around the parent company versus standalone, and what goes onto public record. And with the LLP, there is no corporate tax filing. It's all the profits are attributed to the members of the LLP, and then they submit their personal tax returns in the UK. So I've covered in high level a few tax considerations already, but just to reiterate, there's no withholding tax usually on dividends paid up from a limited company to the Irish parent. The personal tax considerations are definitely worth considering if you're looking to send personnel to the UK. So any key management or any workers into the UK, just consider how long they're going to be there for, what type of work are they going to be doing, will they be entering into contracts on behalf of the company, are they making management decisions? There may well end up being an exposure in terms of personal tax requirements in the UK. So to definitely consider that, speak to someone about that, speak to us if you'd like. We'd be very happy to speak to you and talk you through the options there. With regards to inheritance taxes, just a consideration for particularly in most cases with Enterprise Ireland clients, that would be the limited company option. So if you have a business in the UK and that has a value which exceeds the inheritance tax threshold in the UK, then you may, upon death, your estate would potentially attract UK inheritance tax. So it's just worth considering that in terms of a move to the UK and how you might go about structuring that move. EAS and SEIS, I know that there are similar schemes in Ireland. It's just to say that there's no difference between the limited and branch in terms of who can access it. It's just worth also considering that no entity can be controlled, so majority owned, in order to access EIS or SEIS. And then finally, just on to the registered offices. So there are a few different types of address that are mentioned by Companies House, HMRC, Companies House and HMRC, and these are the three main ones. So HMRC actually need a couple of different addresses, but if I start with the registered office, which is at Companies House, so this is on public record, and this is your legal office address. So it's a good idea to have this as your company secretary address, if that's a corporate company secretary, your accountant, your lawyer, because all the legal correspondence that they would need to see will go to that address. It can be a third party, as I've said, but it is on public record. So good idea not to use a home address if you've got remote workers or anything like that. I'll just skip to the service address because it's fairly similar, but this is also a Companies House and on public record. And it's just the address that's given to the named directors at Companies House. So any director of the business, their name is on public record at Companies House, and they will need an address for any legal correspondence pertaining to them and their directors' duties. So that can be a third party, as I've said. So again, lawyers, a co-working space, a virtual office, not a problem. Accountants and company secretaries too. With the trading address, and under this, I'll just cover sort of really the address is held by HMRC because that's where the trading address is held. So when you incorporate, you'll have to register for a corporation tax. That's for a limited company or a branch, and HMRC will need your business address. Now, for that, you can use a virtual address. You can use any of the addresses that we just mentioned there in terms of third parties. However, when you register for VAT, which in the UK, if you have an entity in the UK, would be when you cross over £90,000 of revenue in a 12-month period, you will be required at that point to register for VAT, or that you can opt to register early. When you register for VAT, you'll need to give a trading address. Now, this is the physical location where the business conducts all of its operations. So that's if you have leased an office or bought an office, that's the address you'd give. It's not on public record. If you haven't leased an office or acquired an office, then you can use co-working space. You can use a virtual office, but only if it has a physical presence as well. So some virtual offices will explicitly say it is purely virtual, in which case you can't use that as a trading address. Some virtual offices will say that you can also hire meeting rooms, on site, in which case that has a physical presence. So that would be for management meetings and things. So in that instance, you can use the virtual office with a physical presence. You cannot use a exclusively virtual office. So you can't. You also couldn't use your accountant or lawyer or corporate company secretary, because that's not where the business is conducted. Best not to use a home address for that. Again, it's not on public record, but if there's any issues with liability pay owed to HMRC, they'll come knocking at the door of the registered office. So and they can seize assets if they need. So yeah, again, best not to use the home address unless it's maybe the owner, and the owner is happy to do that. Certainly, an employee is not going to be comfortable doing that. So I think that was a bit of a whistle-stop tour of corporate structures and key considerations when entering the UK market. Any questions, please do get in touch. Details on the screen here, or get in touch with your Enterprise Ireland relationship manager or account manager. I've included my colleague Ruth here, who is a tax partner here at Ecovis. Just because she does a lot of work with Enterprise Ireland, unfortunately, she couldn't make the presentation today. But hopefully, we've covered enough in sort of high-level terms that if you have any questions, please do get in touch. We're happy to do a half hour, an hour on a call with you, completely free of charge, no obligations, just to give you a bit of a steer. Yeah, any questions, please do get in touch. Thank you for listening.